Welcome back to the Longacres Finance channel. Did the arrival and popularity of fractional shares and zero commission trades kill DRIPs? In case you don't know what DRIPs are, the word DRIP stands for Dividend Reinvestment Plan, and it's a wonderful product if you happen to be a dividend investor, or at least it used to be. Fractional shares are a newer standard and are available on most brokerages today. The first introduction of fractional shares came about in 2017 by M1 Finance. Popular trading platforms Robinhood and the Cash App followed suit in 2019. And more mainstream brokerages like Fidelity and Charles Schwab offered their own versions more recently. Another benefit that came about at the same time as fractional shares was zero commission trades. This was a huge benefit for most investors as it allowed easier access to the stock market and benefited investors from a total return perspective. But are fractional shares and zero commission trades actually a good thing for the average investor? And did they eliminate the popularity of dripping dividends? Let's take a closer look and find out. I'm fairly young, but I can clearly recall the days when I had to pay $7 to execute a trade, while also being forced to purchase full shares of stocks. If you're older, you probably remember the days when you had to pay $10 or even $20 to trade on the market, and you likely had to call your broker to place the order over the phone. Computers, technology, and optimization have certainly come a long way for how we invest our money today. And those are generally good changes. Lower fees and no fees are also a change for the better. Not paying anything to execute a trade today is certainly beneficial from a return perspective, but it does come with a caveat. Just a few years ago, my broker, Charles Schwab, used to charge me $4.95 per trade, which meant that if I wanted to invest $100, I would have to incur a 4.95% fee on that trade. That's a pretty big blow towards your return. Starting out almost 5% down right out of the gate was not very appealing. This led me to pool my money until I had at least $1,000 before I initiated a trade. At this threshold, the fee for my trade was about 0.5%, which still wasn't ideal, but it was bearable. Of course, during the accumulation period, my money was not invested, so it didn't benefit from market gains. And since stocks generally go up more than they go down, over the long term, it meant that I was worse off letting my cash sit uninvested for extended periods of time. However, when my cash balance reached $1,000, and it was time to make a purchase, this slower investing process did force me to think really hard about where I wanted to invest my money. There was no free do-over if I made a bad decision. Selling a position would also cost $4.95, which meant my bottom line would take an additional hit if I decided to change my mind. Zero commission trading and fractional shares remove this burden from investors. But they can also lead to rushed decisions, and people on average executing more trades than they would have in the past. I think economist Eugene Fama phrased it nicely when he said, "Money is like a bar of soap. The more you use it, the less you'll have." This basically reiterates the theory that time in the market is more important than timing the market. And fractional shares, along with zero commissions, have made timing the market much easier. Chances are, the more trades you execute, the higher the probability that you'll hurt your returns in the long run. This won't be true for everyone, but it certainly proves to be the case looking at averages. Looking at my own personal investing process, I have certainly adapted to fully utilize the new benefits offered by brokerages. I invest my money the moment it settles in my brokerage account, and I take advantage of fractional shares. But I still try to force myself to think really hard about where this capital is allocated. Being a dividend investor with a long-term focus makes this process a little easier, as I seldom sell my positions and I try to invest in companies I plan to own forever. As a long-time dividend investor, I have also become very familiar with dividend reinvestment plans. Before zero commission trades, a dividend reinvestment plan meant that you could reinvest your dividend income for free, as soon as it posted to your brokerage account. This was a very big deal, especially if your portfolio was smaller. It meant that your capital could potentially start working for you, earning you more money faster. A few years back, all of my dividend-paying stocks had the dividend reinvestment plan option turned on. The limitation with DRIPs is that the dividend payment gets invested back into the stock that paid the dividend. Today, with fractional shares and zero commission trades, you are no longer limited to reinvesting dividends back into the same companies. You can now distribute those dividends as you see fit. This can be both a good and bad thing. The good thing is that if you think certain stocks are poised to do better in the future, you can direct your dividend income there. You can also use your dividend income stream to keep your asset allocation in line. Some brokerages like M1 Finance do this for you automatically. You can of course turn off this feature in M1 Finance and enter the trades in yourself. The bad thing about directing where your dividend income is reinvested is that with a DRIP plan, dividend reinvestment essentially ran on autopilot. You didn't have to do anything, except sit back and watch the number of shares in your portfolio rise over time. Like I just stated, M1 Finance does offer a smart auto investment plan that can automate this process for you, but the brokerage does have its limitations, and not all brokerages offer these automatic investment plans. There is also a saying in the market that you should let your winners run. This essentially means that it may not be beneficial to sell a position after the share price runs up. Great stocks can continue offering strong returns for many years. With a DRIP plan, you would automatically increase your position in the winners and the losers alike. But a smart auto invest plan, like the one from M1 Finance, will actually penalize the winners and allocate more of your dividends towards worse performing stocks. That's because it's designed to keep your portfolio as close to your target allocation as possible, and it's highly likely that your winning stocks will become overweight positions in your portfolio, and the losing stocks will require more future contributions and dividend income to keep up. I personally have turned off all of my dividend reinvestment plans today, and the introduction of fractional shares and zero commission trades was the main reason why. I'm sure there are plenty of people out there who still like drips and continue to use them, but for me, it makes more sense to self-direct where my dividend income will be reinvested. Whether this works out in my favor in the long run, time will only tell. I still continue to think very hard about where I invest my money, and more often than not, I invest my dividends, or at least a portion of them, back into the same stocks. Let me know in the comments below if you still use dividend reinvestment plans, or if, like me, you self-direct where your dividend income is invested now. Thank you for watching. If you enjoyed the video, please give it a like and subscribe. See you next time.